Hey folks, good afternoon. Today is Friday, February 23rd, 2024. Happy Friday. And I want to share with you that my phone has been ringing a lot recently with people wondering if they should be getting back into the market soon. And with the market once again reaching all-time highs, I can understand why the fear of missing out might be starting to take hold. But let's remember that all that has really happened here is that the market has returned to levels that it was at about 2.5 years ago. And with the recent sell-off last week of over 500 points in one day, it's just one more reminder that there's still a lot of sloppiness out there. Since late October, the markets have shown a nice rally, primarily on the comments from Fed Secretary Powell, leading folks to believe that the Feds will begin reducing interest rates soon. If you've been following these videos for a while, then you know that there tends to be a relationship between bonds and interest rates. We've seen that when interest rates go up, bonds tend to suffer. And the reverse is true. When interest rates go down, bonds tend to do well. But in 2022, we had the worst year in human history for bonds due to Feds sharply increasing interest rates. And now it appears that the Feds may be slowing, and we have seen some of the biggest inflows into global bonds in over 8 months. One of the biggest bond funds out there now tops assets of over $100 billion, and that's just evidence that the market believes the Feds are more or less done for now, and the expectation is next that Feds will start to cut interest rates. But that is by no means a certainty. The Feds are likely to cut fewer times and start later than may have been hoped. Most economists are now predicting that interest rates won't drop anytime before summer, and even that is not a certainty. Business Insider recently wrote the current market problem is that the expectation that interest rates will fall soon, and if that fails, a lot of investors are going to be hurt by that. The fact is, inflation remains stubbornly strong. And if that continues, it would be difficult to imagine a scenario where interest rates would be cut anytime soon. But guess what? Inflation is likely to continue. And why is that? Because let's just remember what inflation really is. Inflation is not the cost of things going up. Inflation is the value of money going down. Money has value because it is scarce. But when you print trillions of it in bailouts and stimulus, and then you reduce the value of money, I think it's a good time to remember that inflation is completely intentional and was orchestrated by the Feds and the government in order to rescue heavily indebted governmental bodies. Your food bill is up 35% so that Illinois doesn't have to exercise fiscal restraint. And not to get too political here, but I do believe the government is looking more and more like the Ministry of Truth from George Orwell's 1984 novel, where they tell you what they want you to believe, not how things really are. The government can't tell you inflation is intentional because that would freak everyone out. So instead, they tell you something different. For instance, remember this one?
In the end, it will be transitory.
No, I'm in the camp that it's transitory.
Doc, why did you think inflation was temporary?
The word, of course, transitory is what you're referring to. And I not only believe, but I've said, and this is...
Well, is temporary and transitory, those are synonymous, right?
Yeah, those are they're synonyms. And
okay,
I think
tell me why...
But I think transitory was...
Tell me why you thought inflation... I'm going to be accurate. Why in your infinite wisdom you thought inflation was transitory?
And now the Democrats' big idea is to try and inflate their way out of inflation. Inflate their way out of inflation. That will be one wild ride for working Americans.
Our experts believe, and the data shows, that most of the price increases we've seen were expected and are expected to be temporary.
I think it's probably a good time to retire that word and try to explain more clearly what we mean.
Yep, transitory. And here we are almost 3 years later with stubbornly high inflation, and while the supply of money is reducing off of COVID level highs, it is nowhere near back to normal yet. Not only is inflation a self-inflicted wound, the Fed is using a modified version of the Consumer Price Index when they tell you that inflation is coming down. Again, Ministry of Truth. They tell you inflation is getting better, but unless you dig into the details, you wouldn't know that the measure of inflation they are using doesn't include housing and fuel, because obviously nobody needs housing and fuel. But if you factor housing and fuel back into the equation, then inflation is closer to 6%, with last month being the highest increase in over 19 months. Overall inflation is up 17.9% since Joe Biden took office. And frankly, many economists are starting to sound the alarm bell on what is really going on. The United States continues to spend money like drunken sailors and print money to pay for a seemingly never-ending stream of overseas wars. And it's not just Ukraine and Israel. We have military obligations all around the world, from Germany to South Korea to Vietnam to Afghanistan to Iraq to Africa to Japan. And the list goes on and on. It's not beyond the realm of imagination to think that in the same way the Reagan administration bankrupted the Soviet Union into non-existence through outspending them during the Cold War might currently be happening to us. We are deficit spending and borrowing our way into a negative debt spiral that, if it doesn't stop soon, many economists predict will be unrecoverable, and nothing we can do can stop an economic collapse because the interest we pay on national debt exceeds the tax base we have to pay it with. Even Federal Secretary Powell had this to say last week.
How do you assess the national debt?
In the long run, the U.S. is on an unsustainable fiscal path. The U.S. federal government's on an unsustainable fiscal path, and that just means that the debt is growing faster than the economy.
So what does this mean for your portfolio? Well, to start, we believe that stocks are currently overpriced. The simplest measurement of stock pricing is the price-to-earnings ratio, and in normal times, the S&P 500 should be around 17%. Currently, it's around 23%. We believe there are no fundamental economic or business principles driving this market growth, save for the expectation that AI or increased production through technology will lead to higher profits in the future. But many folks believe that the AI situation is starting to look a lot like the dot-com era bubble. Many economists and prognosticators feel that investors are way too optimistic about 2024. Many are suggesting to stay away from U.S. stocks and that we should expect the AI bubble to burst, and suggest that we are not out of the woods yet for the risk of recession. Markets are in a very dangerous position. And check this part out. We still have not meaningfully talked about debt. And there are credit card delinquencies, auto loan and mortgage delinquencies currently at national historic record levels. Mr. Ray Dalio, in his recent white paper, suggests that 2024 will almost certainly be a pivotal year in terms of a number of ways. For example, whether the border crisis will be resolved or global conflicts will be contained. Top NATO Admiral Robert Bauer warns of a potential all-out war with Russia. And we believe if we are not adequately factoring in these risks into our portfolio, we are probably being overly optimistic about the future, and we haven't even talked about China in this video. You may have seen news recently that a British-flagged cargo vessel carrying hazardous chemicals was hit by a Houthi missile where the crew had to abandon ship, and the vessel is now at risk of sinking, and now the British Air Force is involved with us in striking Houthi targets. This is escalation. A senior U.S. defense official recently warned that they are concerned that the U.S. public has been lulled into a false sense of complacency by thinking it is easy for for the Navy to keep defending ships. And if one missile gets through and hits a U.S. warship, he says the escalation that will follow is very serious and should give people pause. We are literally knocking on the door of World War III in the Middle East, and that could spiral out of control super, super fast. We would continue to caution investors to take a measured approach with their investments. Higher for longer for interest rates is likely our continued reality. And even though we may see some interest rates cuts in June, and never mind the question of whether that's in our best interest or not, these potential cuts have already been priced into the market. I'm looking for what will drive this economy higher. I don't care so much about the next 500-point rise in the market. I'm interested in what will drive the next 5,000-point rise in the market. Cutting inflation or interest rates is kind of like cheap fuel. I'm looking for actual earnings growth, new innovations, reductions in regulations that allow businesses and economies to grow, a reduction in military spending overseas, and all of these things, prudent fiscal and economic business policy that leads to real growth, not just a shuffling numbers. I believe it will be some time before we see that come to fruition. And the biggest issue by far is still national debt and national spending. Mr. Dalio has been warning about this in his books for years and years, but it still just keeps getting worse. There is a 5 millennia precedent that this doesn't end well, based on historical research by Mr. Dalio. And yet, the national debt is still ballooning, and there are still trillion-dollar deficits as far as the eye can see. Under current U.S. policies, U.S. government interest payments per day have doubled from $1 billion per day before the pandemic to almost $2 billion per day in 2023. And outstanding debt will grow to over 200% of gross domestic product in a truly depressing achievement. The national debt has recently exceeded the value of China, Japan, Germany, India, and the United Kingdom's economies combined. Jamie Dimon of JP Morgan writes that the U.S. debt is the most predictable crisis in human history, but there's no real good end here. It's almost inevitable that the credit bubble has to pop, and Powell says it is past time for an adult conversation about fiscal policy. So, we need to factor in that one of the biggest drivers of growth in the economy right now is government spending. And the only way that we can meaningfully reduce the national debt in any meaningful sense is to cut spending and raise taxes. Imagine now what cutting $2 trillion a year of spending or more and simultaneously raising taxes would do to the economy. It's very possible that we could see a repeat to what we saw after 9/11, times a multiple. Many years, even decades of sideways movement in the market while the economy digests higher taxation and lower government spending. Sooner or later, the U.S. has to wake up to the fact that you cannot spend your way to prosperity, and hopefully that happens sooner rather than later for the benefit of us all and the continuation of the United States of America. In the end, I would encourage you not to get too excited about recent stock market returns, not just yet. Remember, it only represents a return to where we were in the fall of 2021. I am looking for what would drive the economy higher, and I don't see much out there. We would encourage moderately aggressive investors to keep some of their portfolio in a moderately or in conservative positions and to watch the data closely. And of course, if you need some support with that, please don't hesitate to reach out. I'm hopeful that by summertime and client dinner time, we will have more data and information that will help us know what to do next. I'm also very pleased to share with you that we have scheduled our 12th annual client dinner this summer for Friday, July 19th at the Bond Ballroom in downtown Hartford. I'm also thrilled to share with you that our keynote speaker will be none other than Mr. David McKnight, the author of Power of Zero and Tax-Free Income for Life. And it's my belief that dealing with taxation on your retirement assets will be the single most effective tool that we can bring to the table as your financial advisor in the years to come. If you'd like to learn more about this, I encourage you to check out the Getting to Zero research page on our website. And again, please reach out if you'd like to discuss this any further. And as always, thank you for your continued confidence in the work that we do.